Hello everyone, welcome to this video. Today we'll be talking about the global economic situation because as you might have experienced, it's a total mess. And we'll be talking about this situation that we are in from two different perspectives, from the perspective of economic growth and from the perspective of inflation. And both are actually very much interrelated. So you'll be seeing throughout the chain of events that they actually go hand in hand. So, without any further ado, let's jump into the topic. Why are we in the mess in which we are in? And our story starts actually with Donald Trump. Why, you might say? Because our story actually goes back all the way until 2018. In 2018, you might remember that the US actually declared a trade war upon China because Trump had the opinion that China was not buying enough American products, and so that the trade balance between US and China was actually skewed in favor of China. So Trump wanted actually China to import more US goods. China said that it was unfair and that it was, just about market conditions. And basically what the US did was impose trade tariffs and so make it actually much more expensive for Americans to buy Chinese goods. Well, what this resulted in is that China said, hey, that's not fair. You're actually hurting our exports. And so China did the exact same thing and put tariffs on American products. And so a tit for tat actually procedure went on. And between 2018 and 2020, this whole situation escalated. So you might say, hey, why are you giving us a lesson in history? Well, because it's very much important, because between 2018 and 2020, as this whole situation escalated, global trade actually also hurted a lot because the US and China both are the most important economies in the world, and so both also have a major stake in global trade. And with that also, as trade is also an engine for production, for investment and for consumption, whole economic growth actually was negatively hurt, and so global growth actually declined. And so, as you might have also experienced, in 2020, something else happened. So as this whole trade war was escalating, we also got to face the pandemic, right? The COVID-19 pandemic. So without us actually recovering from this trade war, and so without global growth, economic growth getting to the level at which we wanted it to be, then also the pandemic, right? The COVID-19 pandemic hurt our global economy. And that is actually also, again, in a multitude of ways. Consumption was hurt because we didn't want to go out and consume. Sometimes we even couldn't because of rules and legislations preventing us from going out at a certain point of time or to certain stores and whatever. Production was hurt because consumption was hurt. If you cannot consume, if you see that people are not consuming to the levels that they normally did, then you also don't want to produce because then there will be overproduction. You cannot sell. It's a waste of resources. So as consumption went down, production went down. As production went down, investments also went down because those who invest see that consumption shrinks, production shrinks. So why should you invest knowing that this is a downward spiral? And so in such a situation, what you also saw is that investments went down. Consumption, production, investment going down meant that trade went down and that basically the global economy was again massively hit. And so as the combination of the trade war and the COVID-19 pandemic was too much of a hit on the global economy, countries and supranational institutions like for example the World Bank, IMF, whatever, all sorts of countries, institutions, country dependent and supranational institutions started supporting the global and national economies. So the problem here is that they couldn't do this through interest rate policy because the interest rates at that point were already low because economic problems already started 2018, and even before that, if we go all the way to the financial crisis, even then we already started with having our interest rates being at a low point. We kept the interest rates at a low point throughout the trade war, and now we end up with the pandemic again. The interest rates were at the low point. You cannot make them lower than they already are because some countries took the interest rate below the zero level to the minus. But how far do you want to go? So the idea behind interest rates is, of course, that if interest rates are low, it becomes cheap to borrow, and with this to consume, to produce, to invest, right? And so getting close to the 0% level, that's great. It supports the economy, but getting to a minus means that you're actually going to punish people, right? You're going to ask people to pay money for putting, for example, their money on the bank, but also to institutions for stalling their money at whatever type of institution. So negative interest rate is not exactly what countries want. 0%, 0.5% interest rate, fine. Minus levels, actually not good. But the European Union actually had an interest rate at the minus level. The US was at the zero level, could go to minus, but they didn't want to. So long story short, we had an interest rate problem. We cannot go lower in interest rates without this also actually derailing a lot of the pillars of the current financial system in which we're in. So what does this mean? This means that if you cannot support the economy through interest rates, you have to do it in a different way. And so you can do that by basically pumping money into the economy, right? You can sell your reserves, or you can put your reserves to use, pump it into the economy. You can buy assets from financial institutions, from companies, from whatever, and give money in exchange. Or you can also just gift money, right? Or you can basically also give money in loan. So all sorts of ways in which you can support the economy by basically pumping money, especially cheap or free money, into the economy, right? In some cases, people even got checks, right? Blank checks, or at least free consumption checks that they did not have to give back to the country, to the government, and they could just spend this. So great, it might seem. You're supporting the economy because you're giving money, and this should lead to consumption. Consumption should lead to production and to investment. But this leads to a different problem, which is that consumption is relatively easy to affect, right? If you're putting money into the economy, at least give money to people, they will do something with it. They might put it on the bank, but they might also simply spend it one way or another. That money is going to enter one part of the economy. The question is, where is it going to enter, right? That's already a problem. Are people going to spend it the way in which you want them to spend it? The second problem is that, okay, they might consume, but is production and investment actually going to match the pace with which consumption is going to increase? If you give someone money, they can spend it directly, but production needs time to get up to the level of consumption. Investment also needs time to get up to the level of consumption again. So as consumption goes up relatively quickly because of these checks, right, or because of loans or whatever, production and investment actually cannot match that. And if demand increases faster than supply, so the demand for goods and the supply for goods, right? If demand for goods goes up quickly, supply of goods lags behind. Well, that's basically what inflation is about, right? You have people wanting to buy, but they cannot buy, so they're willing to pay more for it, so the price goes up. So inflation. And so the trade war in combination with the pandemic required countries to and all sorts of institutions to massively support economies, and this led to inflation because consumption went up much faster than production and investment. So we're not there yet, because what then happened was basically the war between Russia and Ukraine. Because what you got here is that this whole situation, this war, accelerated inflation even further. Why? Well, because these two countries are very important to the global economy in two important ways. One, the exports of grain, and grain being an important input for a lot of the products that we consume. Not only grain, but for example also sunflower oil. So an important part basically of the foods or products in general that we consume from a food perspective. The second issue is energy. Russia, of course, an important country in terms of oil and gas. Exporting it again is one of the things that became part of this war, because what you got is that in this war ports were of course also destroyed, were attacked. So ships were not really safe of whether they could keep on doing whatever they did, like they did before the war. So basically grain, sunflower oil, the things that Ukraine normally exported, they stopped exporting because they feared that their ships were going to be blown into pieces, but also simply the whole chain of production and supply was of course hurt by the war. Russia then threatened the whole world basically of cutting supplies of oil and gas if the world would interfere with the war, right? And if the supply of grain goes down, even though we demand equal levels of it, same thing counts for sunflower oil. And if the supply of gas and oil goes down, even though we demand it yet again, then what's again going to happen is that demand is at the same level, kind of, supply goes down, and so you get again a skewed relationship, which basically means we're willing to pay more for the same goods. And so this again is inflation, and we already had an inflation problem. Now we have an exacerbated inflation problem, right? And so what normally would happen if inflation goes up, and I'm talking about the inflation levels after the pandemic, not even talking about the levels that we now have gotten with the war going on, but in normal circumstances already, what you would have is that central banks would hike their interest rates, right? So that spending money, or at least borrowing money and spending the borrowed money, would become more expensive, right? So people will buy less houses with a mortgage, for example, or they will have less consumption credits. But also companies will invest less and they will produce less because they would require, again, loans and checks for this. So normally interest would go up. With this, less money would be spent, demand would go down generally, so and inflation would go down. But this time that had not been the case because both the Fed, so the Central Bank of the United States of America, and the ECB, the Central Bank of the European Union, they have stayed very, very passive. Inflation got out of control because of this. Interest rates have now kind of started to go up, both in the US and in the European Union. But the question is this not too little too late? So Fed now is kind of at a 2.5-3% range, depending on when you watch this movie. But inflation is around 8 to 10%, right? Same thing counts for Europe. But in Europe, the interest rate is being hiked even less fast. It's now at 0.5% compared to in some countries an inflation rate of about 10%. And so normally, what you would have is that the inflation rate would be matched by the interest rate. But if you would have those types of interest rates, that would mean that we would completely derail the economy. So nobody really wants that. But it also means that we have to quickly get higher interest rates to prevent inflation from going out of control even more so that we don't have to, in the end, get even higher interest rates. But for now, that's not going on. And for now, you also see that the ECB is actually going much slower than the Fed. The reason for this difference is that the Fed actually has a very dispersed economic field that it has to watch over and that it has to control. You see a lot of variation between the countries in the European Union in terms of how they are doing in economic sense. So for example, Germany and Netherlands, they have actually quite a solid a balance, quite a solid economic account. But if you would look at more southern European countries like Italy, like Greece, like Portugal, then those countries have actually a lot of debt, and these countries cannot afford to pay a high amount of interest over this debt. They simply don't have the money for it. And so this would mean that the European Union actually has to give them money to be able to pay for that debt, which is what a lot of countries don't want. But it would also, again, lead to more inflation because you would get more money in circulation. And this would also basically beat the whole purpose, and would also actually mean to these countries that they don't have to care about debt because somebody is going to jump in and help you anyway, right? So it's a big problem. So the ECB, because of that, is hiking its interest much less fast. In the US, economic situation is much more homogeneous across the states, and because of that, the interest rate policy can be much more homogeneous as well. Um, so yeah, in such a situation, what do you do? Well, what at least happens is that because the dollar gives more confidence, and because the interest rate that you will get, the interest that you will get when you have dollars and put those on the bank or when you utilize them is also much higher, what you see is that the demand for the dollar is also much higher. So the dollar against the euro has gained a lot of value, right? It's now at the parity level, kind of $1 kind of is €1. And this situation is going to last, I guess, for quite a while. Also because simply the Russian-Ukrainian war is hurting the European Union much more, right? The European Union is much more exposed to the war, and with that, the negative consequences affect the European Union much more than the US, which is kind of at the other side of the ocean. So, putting everything together, so now what, right? If you look at the future, what can we expect? Where are we going to? And so it depends a lot on the developments, right? It depends on what's going to happen in the Russian-Ukrainian war, right? Is this war going to linger on, or is this going to stop at some point? If it is going to linger on, this will mean that upward inflationary pressures are going to continue. And this means that, again, we have to expect a lot from the central banks. And will the central banks step up their game and get the interest rates at the level at which inflation is going to go down again? So that's a big question as well. Amid all of this, the question is, are we in a new reality of kind of high interest rates and high inflation? That depends on how willing governments and monetary institutions are to bring down inflation and to preserve economic stability. Also, from a bookkeeping perspective, elections in many countries at some point will come. And with that, high interest rates, because they hurt employment conditions and because they hurt economic growth, they're not very popular measures to win an election. And so when politics is going to conflict with economic situation, well, then we might have a problem. So it very much depends on what monetary institutions are going to do, what politicians, what countries in general are going to do. And so we have to sit tight and wait. In the short run, inflation won't go down very fast. Economic growth won't go up very fast. So this is kind of the situation that we have to do with in the short run. And depending on the measures and depending on their outcome in the mid to long run, we can again have an more positive upward look in terms of economic conditions. I hope you enjoyed the video. I hope it was useful. If you have any questions, please let me know. And if not, I wish you all the best in the world. Please don't forget to hit the like and the subscribe button. And I hope we'll see each other again anytime soon. Take care.